basic knowledge about startups. Just a second, I think it's hanging.
Darshan sir, any help?
No. I'm just, it was hanging in, so I'm just sharing in the presentation. You can view my presentation now. Okay, can you hear, view my presentation? Okay, very good. I'm just going into the presentation mode. All right. So to start out, I'll just take about a few minutes about angel funding. Now, like all of you know, angel funding. 1 minute. Okay. So basically, what is angel funding? See, basically, when an entrepreneur starts or wants to start a business, the entrepreneur has some kind of an idea where the entrepreneur wants to capitalize on the idea and start a business and grow the business. Now, for all this, you need something known as capital. So when the entrepreneur has an idea, now he or she would like to get the idea into a concept stage, get a product or a software to be developed or to be made, or a product to be made, or a software to be developed, and then they need to test it and with the right kind of market. Then they would like to see whether that product and software has a saleable market to the right audience. So this is where angel funding has come in. If you actually see how this has started, initially, even before angel funding, if you see traditionally, I'm talking about almost a decade back, most of the businesses that were started were more on family businesses, family-run businesses who had money, who had started the businesses, and they had put in their own business money to run their business. So there was a slow growth towards it, unless then one by one, people started growing the businesses, be it in different sectors, be it in textile, steel, you see in food, everyone started growing it. But later when the business were established, there were certain gaps in a lot of areas which had to be filled in. So this is where the new entrepreneurs started coming up with ideas where there is an existing solution, but make the solution more marketable, more scalable. So they started coming up with their own ideas. Now, if you see, traditionally family businesses were funded either by the family members, or they used to go down to the bank, give collaterals and take loans. But when it comes down to angel startups, unfortunately, the startup entrepreneurs have great ideas, but they don't have that kind of monies to go and give in the collateral. So that is where they needed help from individuals who go ahead and who understand or who are in line with their ideas, who are in line with what they're doing, and who are able to fund it. That is why we started out this angel funding. The angel funders come in, and there are different categories of angel funding. Now you have individual angels who fund startups. You have angel networks which fund startups, and you also have institutional that is VCs, which are institutional institutions which fund startups. Now, like I told you, there are individuals which is angel investors. You also have family offices where families which are running businesses, they set aside a quantum of fund to help startups, entrepreneur startups to fund their ideas. And you also have institution venture funds like institutions who are ready to go ahead and put their money also in startups which are established. Now, what are the various stages of investments? Now, the first one is an idea. An idea is, like I told you, when the entrepreneur has an idea. Now, the entrepreneur puts his or her money into the idea, getting a concept, get a product, and then they want to go down to the markets. But now to go down to the market, they may not be having that kind of funding. So what they do is, now for a startup, they would put in their money, families, friends' money, and then bring up a minimal viable product down to the market to see what is the traction that they can gain. Now, once the product or the software has gained some kind of traction, then the next step is growth. Now, to fuel growth, again, you need money to be pumped into the system. Now, that is why when we say scale up, that's where we come in as angel funders. Angel funders, where we put in the money to see if we believe that this idea can grow to a next level. So we looking at various parameters, like as I'm going down with the presentation, you will get to know exactly what the parameters can refer to. And finally, you go on to different levels. You go into angel funding, you go to pre-series A, you go to series A funding, you series B, series C, venture capitalists, then you go to private equity and IPO. This is what we look at. So what is the quantum of money that you can expect from various levels of funding? First one is your family and friends. That is like I told you, when you're looking at starting an idea and you want to put some money into your idea to become a concept and get a product out. So you approach your family, your friends, you put in your own money up to a point of about 1 lakh to about 25 lakhs. Get the product, get the software ready to an extent where it can go on to the next stage. When I talk to the next stage, where you have prototyped it, you have tested it with the right market, and after testing it, that has got you to get more orders. Now to execute orders, you don't have that kind of funding because you've already used up the amount what you had for product, your product, and set up office, set up your team to a basic level. This is where the angel investor comes in, and when the angel investor would look into what is the kind of progress that you've made, and we invest up to about 1 to 2 crores. Now, after that 1 to 2 crores is for you to take the deal down to a certain stage. And after that, the entrepreneur needs further growth. They need further expansion. So then you go down to venture firms. You go down to institutions where you're saying kind of pre-series A, where they fund in up to 3 to 6 crores. Again, that would take you for a runway of maybe about 24 months. Then again, you need to grow. And then you go into Series A, Series B, Series D. And after that, you go into a private equity before IPO. These are the various stages at which an entrepreneur could grow on. So now I would start. These are the 15 slides which I will be taking you through of how an entrepreneur is supposed to prepare their presentation pitch. We're talking about, first thing what they need to know is about the team. So about the team. First of all, when an entrepreneur has an idea and wants to get out the idea, get a concept, and then you want to form a company, a private limited company, it is always advisable that the entrepreneur is not a solo founder. You should also have kind of 1 or 2 co-founders. Why? Because the entrepreneur singly cannot handle the whole business as such. An entrepreneur cannot look into marketing, cannot look into sales, cannot look into production, cannot look into growth. You need people around you. You need trustworthy people who are on the same page as yourselves to have a team. So it's always recommended that you have at least 2 to 3 people who are a part of the founding team. Otherwise, if it's going to be a single founder, then it could be a red flag for the investors. Now, when you have people in the team, it's very important on what kind of a startup you are going to start, because at least there should be 1 member in the team who is a domain expert in that sector. for you to have started the startup, because that person would be able to understand the business well enough, and the other two founders can work around the domain expert. And very important to know is how much has the entrepreneur put his or her money, invested his or her money into the deal. For example, say if an entrepreneur has just put in about a lakh into, and then looking in for an investment close to almost 1 crore. What happens is then there's a doubt that will be raised in the investor's mind of if I put in my money into the startup, and as going forward, if the startup is not able to scale for any reasons that the startup is not able to go forward, what happens? The money of the investors goes down the drain. So it is very important that as an entrepreneur puts his or her money, family, friends, a sizable quantum of amount has to be invested. Only then will the importance on the deal stay. Second one is your problem statement. What is the problem that you have identified in that sector that you are starting a business or your startup? What is it that you are trying to, what is the problem that you're trying to solve? Most of the businesses right now, when most of the entrepreneurs who have started right now, there is already someone who has started the business, and there's a way of which the business is functioning. So now the entrepreneurs actually found out an idea or an issue in the existing startup or in the solution, and trying to leverage on that idea to go in. So we need to understand is if there's a person who started a business A and is running in for 10 years, and then I come up with a solution saying that this is how A to Z the business is running, but there are some gaps where I feel I can fill up, which is big enough to be addressed. So I can always complement what the person is saying, and I can grow the business. Now, once I've identify the issue, what is the kind of market am I going to address who are ready to take this kind of solution? So this is something that an entrepreneur is supposed to look at. Now, I have identified the problem. Now comes the solution. So the solution can be two ways. Either it can be a painkiller or it can be a provider. What I speak of the painkiller is, there is an ongoing process, but I have found a solution which is the need of the hour to be solved. So which other, when I implement this, I know that it's going to make my business grow at a very exponential rate. So that is a painkiller, which is a solution is required by the customers now. So that way a customer knows they don't have to wait for long, and they know that I am providing that solution. And I know that I have more customers coming in to me, so the growth factor is there. The second way of looking at a second kind of vitamin saying that there is a solution going. Mine, I have found a small problem which is not going to actually solve someone's problem fully. I'm just complementing a solution which is ongoing. So this is basically, I'm saying that I'm trying to sell a product down to a customer. And in the process of selling, I've just found out that if I can tweak the marketing a little better, that product can be sold. That's a vital. It's not a major problem. So that is what we said, and that is going to be more of a lifestyle kind of business, not an investment kind of business. So it's very important for you to make sure that the solution is one of its kind solution. You people have found out the solution, and you're going to hit the market. Then comes the market opportunity. Market opportunity is very important. First of all, if I'm going to say that I've gone into a FMCG, I'm trying to, I'm trying to sell something in FMCG, say, for an example, a drink, a health drink. I first of all need to understand what is the overall market for a health drink. When I say overall market, I need to know what is my overseas market as well as my Indian market. What is the size of the market in terms of value? Now, then I have to do, as an entrepreneur, I have to do my homework to see what is the growth rate of this market. When I say the market is a 2 trillion, how long has it taken for this market to grow to a 2 trillion market? That is what me as an entrepreneur should do. And of the 2 million market, what is the kind of market I am going to address? Because I'm not going to go and head on with the 2 million market. I would say of the 2 million market, my market size, that is the people I am trying to market, is 2 billion market. That would be my market size, because FMCG is huge. When I've taken an example of a health drink, it's huge. In health drink, who are the people who are the people I'm trying to target? Competition. So when it comes down to competition, I'm just taking an example of the health drink. So I need to understand who are my competitors in the health drink. The name of the competitors. Now, are the competitors in the same segment? Very important for me to know, because a health drink can be there. Now, there are different kind of health drinks I'm going in. In general, I'm talking about. Now, are they in the same sector or same kind of segment that I am addressing? If yes, I have to name them out as a competitor analysis. Say my company ABC versus DEF versus EFG, and what are services that I am offering vis-a-vis what is it that they are offering. So that is basically, I'm trying to say that how different am I from the rest. Next comes down to the business model. Very important for an investor to understand is, what is your business model? For example, are you licensing the business? When I'm talking about licensing the business, is it a one-time license which I'm doing, or is it a yearly? Is it a monthly? Is it a quarterly license? Is it a SaaS-based business? Is it a product? Now, all these are very important for you or for an entrepreneur to showcase in this business model for investor to understand exactly what your business is. Now, when you talk about business model, it also, most of the businesses now are technology. Some technology has some kind of a play in today's business. So we need to understand, is the business scalable using this technology, and how is it scalable? This is something that the entrepreneur has to explain down to the investor. What is your pricing model? So it's very, when it comes down to your entrepreneurs, we need to understand how much are you pricing it? What is the amount that is taken for you to go ahead and make the product? How much are you selling it? And what is the revenue that you're making? Very important to know what is the ROI of the customer. When I say ROI, return on interest of the customer. So this is your customer acquisition. What is the cost of me to acquire the customer? And what is my return on interest when I sell a product? How much is it that I make out of the customer? What is the expected lifetime value? So if I'm a customer, and if you're a customer, you come, you buy my product, say for 500 rupees, how long will you be buying my product? Say if I'm buying your product for 5 years, 500 rupees. So each year I'm buying it for 500 rupees. You're talking about 2,500 rupees. So what is my expected lifetime value of a customer? It's about 2,500. And what is the unit economics? Very important. There is a product cost which goes in for me to make a product. Or if for me to develop a software, there is some amount of money that is being spent. So say that I have a health drink. I'm selling the health drink for 100. My product cost and the formula which goes into for me making the health drink will cost me maybe about 25 rupees. But I'm selling it at 100 rupees. That means I'm selling it at almost about 75%. So the thumb rule for an industry is, if you have a buffer of almost about 50%, that is what investor looks at. Now, go to market. Very important is, we need to understand we know that this is the target audience you're going to. How are you going to approach the audience? Are you going through Are you going through a Facebook? Are you going to Twitter? Are you going through a digital marketer to market your product? How are you pursuing? Or is it word of mouth? This is something that we need to understand as an investor. Now, if you say that I'm going to go through media, that is Facebook, Twitter, or I'm going to go through a digital agency, or I have my own marketing people, or I say it is word of mouth, I need to understand from each what would be the opportunity that I can use this and how much can I scale my business to. And like I said, what is the cost of customer acquisition? For me to acquire a customer, how much am I spending? I'll be spending on marketing. So the marketing cost, whether I'm going to go through Facebook or going to Twitter or I'm going down to a digital marketing, there's some amount of money which is being spent. So I need to understand that when I say what is the cost of customer acquisition, because cost of getting customer is not free. There's an amount of money that I spend to get the customer. So that is something that I have to get. Now, what is the lifetime value of customer acquisition cost ratio? So basically, I've got a customer spending some money. So say customer A has come in, my cost of acquisition of that customer is 15 rupees. Now, how long is this customer going to be with me? And what is it that I can get out of this customer? So the customer spend. So that is the lifetime value which I'm supposed to calculate. Now, next one is uniqueness. When I say uniqueness, I'm talking about the USP. So I have a product, I've done my marketing, okay, my go-to-marketing strategy is gone through. Now, there will be a lot of products which are already there in the market, like my health drink. But what is that uniqueness that I have that is attracting other customers to come down to my product, buy my product or my health drink compared to the others? Now, that is what we need to understand. That is where the product really runs. Now, for example, my USP, is it because of my product, or is it purely only on the product, or is it the way I market it to the customers that my product is selling, or is that I have added some kind of a technology to attract the clients, or is that the way my business model is totally different? This is something that we as investors need to understand that. Or could it be pricing also? That pricing plays a major factor. Is it sustainable? Or in addition to all that, which is the geography? When I'm talking about which is the geography I'm trying to operate, is geography is, am I operating in India? If it is in India, am I targeting the north, east, south, west, central India? Or if I'm in South India, in which part? Am I in which state am I? Am I started? So all this I need to understand. Now, when say that I've started this health drink here in Chennai, and people like my health drink, they like my uniqueness, and they are trying to they're gunning for my product. That is, most of the customers are coming and buying my product. So I need to understand what is it, or why is the customer coming to me? How unique am I to the customer? So this has to be articulated well to the investor in the slide. And one more thing is, do I have the first mover advantage? The first mover advantage is I've got something else. I've got a product which no one else at the moment has a product. So am I able to use this advantage with my marketing skills, with my USP, and sell it? Now, how different am I from the other businesses? Like I told you, there are a lot of direct and indirect competitors, but I need to differentiate myself. So how different am I from the others? This is very important. When I say journey so far, when I started out the presentation, I clearly told you that me as an entrepreneur, I have an idea. And from the idea, I go down to a concept. The concept, I go down to a product level. Product, then I go on to a testing level. From a testing, I go down to getting out the product to market ready. And then I start selling them and I start scaling. So from the time of the idea till the time a person has come down to an angel for funding, we need to know what are the different kind of milestones the person has done. Different milestones with the date, how long it's taken for example, I had an idea in June 2000, say June 2019. I've got a concept of a product ready in August 2019. Now I've done my beta testing in October 2019. So I need to know that kind of historical milestones. And along this time, when I got a product, has my family, friends put in the amount? How much of amount have I raised? How much of amount have I put? As I'm going forward, have I raised more amounts? What is it that I've got? Have I got some? Some kind of recognition in certain places? Have people asked me to go ahead and set up certain? See, my first shop I've set up in so and so place. So I need, this is the kind of historical milestones that you have to put forward for an investor to understand from your idea stage up till now, what are the various milestones that you have achieved. Very important to know during this milestone, when did you roll out the product? When we say roll out the product, roll out the product with this market ready. And during this, we also need to understand when have you started acquiring customers. During this historic milestone, these are certain things we need to know. And how did you get your key customers come on board? Key customers could be, see, my businesses could be either a B2C, a simple B2C, that is B2C is business to customer, or it could be a B2B, a business to business, or it could be a B2B2C, which is business to customer, or it could be a P2P, peer-to-peer. So we need to understand when you say key customers, when I'm selling a product, I've had a huge company who's come and taken down orders. And I'm going to, when I'm doing B2B, a huge company would come, take my orders and continue to be with me. So I need to tell that to the entrepreneur, to the investor, saying that so-and-so company has come in so-and-so time, has placed so-and-so order, so-and-so amount, and they continue to be there. That is very much, that is very important for us to understand. And we need to understand how much you need to raise at this end. So when you're raising funds, it's very important for you, for an entrepreneur to understand where has the entrepreneur reached now, at this point, and to grow, how much does the entrepreneur need, looking at what the entrepreneur has done. For example, I have spent almost about 50 lakhs for me to grow my business from A to A plus. Now I need to go to A plus plus. So what is the amount I need for me to grow to the next stage, and for how long do I need the money? Your current traction. What is the revenue that you have generated so far over the years? It's very important. Okay, for a entrepreneur, maybe the entrepreneur has had an idea for 2-3 years and started moving in, but the growth rate the entrepreneur has started to see is only in the few months. So we need to understand in that 2 years, when has the entrepreneur started generating, that is paid revenue, and from where?
Sir, sorry to interrupt. Few of the participants are telling the voice is a little low. Can you be a little louder, please, if you don't mind?
Yeah, now you can hear me?
We'll just proceed, sir. Participants, if they have any other audio issue, they'll tell them the chat. They're mentioning, a couple of them and mentioned that audio was low. We can continue, sir. No problem.
Okay, thank you. So, like I told you, we need to understand from the time when you have started generating revenue, how much of revenue have you been generating till the time you have come to us for funding. Now, we also need to know, in case you have been generating revenue, say for the past 2-3 years, on a year-on-year basis, we need to understand how much of revenue have you generated, vis-a-vis how many clients do you have on board on that year, and how much of revenue have you generated. And for the present year, you have to give us quarter-wise, because that's the only way we would be able to evangelize as to what is going to be the growth. Now, we also need to understand what is the revenue share from different customers. For example, your revenue stream could be from direct sales. Your revenue could be from online sales, it could be from your website, it could be from third-party website. We need to understand revenues from different customers for us to understand where exactly is your market. And very important, right now, what is your current revenue that is being generated? Say for 2-3 months, we need to understand month on month, what would be your, what is the revenue that you have generated? And also how many customers have you been onboarding in this process? Financial projections. So your financial projections, why we require this is when you come down for funding, an investor needs to understand what would be your growth for the amount of money that you're requested for and for how long. So we need to understand your financial projections for them at least a minimum 3 years. Why 3 years is because only then we'll be able to understand whether you are in the right track, whether you've got your financials right. Is it too overpowering or is it too under? So that way we need to also understand your breakdown on product, geography, and stream price. When I say financials for the next 3 years, for example, I've asked for funding now in August 2020. So I need to understand my 2021, 21, 22, 22, 23, what would be my financial revenue projections over those 3 years. Very important, what will be the burn? Now, what is the burn? For entrepreneurs, when they are spending money for the product, for setting up the office, for their marketing, entrepreneurs are spending money. That is your burn. So we need to understand is what is the burn rate. For example, my revenue I've generated of my health drink is about 2 lakhs per year. 2 lakhs per month. I'm also spending money from my pocket for this. So is my burn rate, that is my spend rate, more than my revenue? This is something we need to understand. And what is a capex and a working capital requirement? Because I have an office, I have a factory setup, I need to run the office, I need to pay salaries, I need to understand I need to understand this breakup of how much of amount that you are seeking funding is going to go towards this capex. And in this next 3 years, how much of money going forward are you going to put in capex? Are you going to retain the money, or you need more funding to go and complement this capex? Next, we are talking about the cap table. Now, what is cap table is how much of investment the entrepreneur has made till date. Now, the investment can be the entrepreneur's money. It could be friends and family's money. Now, it could be even money from where I have an idea. I go and seek advice from another person who understands this. Maybe that person may not be family friend, but is ready, is very interested in the idea and ready to put some initial amount of funds in my company for a small stake. So that is what I need to understand in this cap table. See, it's very important that an entrepreneur does not dilute too much too early. That's very important, because as the entrepreneur keeps going at every stage of funding, from a seed fund to an angel fund, to a pre-series A, to a series A, series B, the entrepreneur should be having the maximum amount of equity with him or her, or with the company. Because if you start diluting too much too early, then that is again going to be a point of concern for growth of the company, because a person at that level will be expecting, at any level, be expecting the entrepreneur to hold on to maximum amount of equity, up to 51%. So say that you are looking at seed funding, you should not dilute at the seed stage, because you need the money, you have the idea. Maximum you'll be able to, you should be able to dilute is about 6 to 8%. So people, a lot of entrepreneurs make a mistake saying that they dilute too much too fast. They dilute almost about 50% because they are in need, urgent need of the money, and whatever the person initially puts in the money gets away with the maximum amount of equity. Because if you dilute too much too fast, by the time you come down to angel round or pre-series A, there's hardly any equity stake that the entrepreneur has, and the entrepreneur become a minority stakeholder, which does not argue well for the business. Now, very important is how much of stake does each promoter have in the company? For example, if you're, I'll just give an example. If you're three co-founders, is it equally divided with all the co-founders? Or is it that one co-founder has the maximum amount, the other two co-founder has very minuscule amount? It doesn't argue well for the business, because when you have a lot of, you have two, three co-founders, each one are putting his or her expertise and use. One may be in marketing who understands, one may be in product who understands, one may be in growth. So each one should be equally equated, because it also depends upon the amount of money each one puts in. So it is much advisable that everyone put in equal amount of money and equal amount of stake to be shared within them. Now, I've started a business. I've hired about 3, 4 people or 5 people or 10 people to run, to help out in the business after my co-founder. That is my team. But I need my team to stay with me. That's called retention of team. Now, how do I retain a team who's just joined a startup and who's seeking funding? That is why we have an option known as ESOPs to be provided for the team. There's some kind of equity, early equity being given down to the team, that is kind of shares to be given, which will be kind of a deterrent for these people to leave the company, because as long as I'm in the company, I have the ESOPs option. And as my company grows, my ESOPs is going to grow. So this is a kind of retention. Most of the entrepreneur, if they follow this, would be helpful for their own business. And finally, is there enough runway for future funding? Like I told you, it all depends upon the equity stake that the co-founders have in the company, not diluting too much. So by the time they actually, for example, by the time they actually come to an angel round, they should have just diluted about 10 to 12%. Now that is that will be very ideal for the angel round, because at the angel round, again, the person is going to dilute about 6 to 8%. Again, you go to a pre-series round, the person is going to dilute about 5 to 6%. Then a series A again is going to be 5 to 6%. So by the time you go to a series B, now entrepreneur should have at least minimum about 51% stake. Like I told you, he should be a major stakeholder. Then it becomes easier for them to go ahead and raise funds. Fund ask and utilization. Very important. Now, how much of funding are you seeking for your growth? Now, I can be a company which is doing a minimum about 2 lakhs. My USP is good, and I need to grow my company from a 2 lakh to a 5 lakh. 5 lakh revenue per month. Now, for me to move to a 2 lakh to a 5 lakh, I need to understand how much of money I require to raise. For me to reach the 5 lakhs, how much of money I need to raise for me to sustain that over a period of time. So that is very important for you to be, for you to calculate that kind of fund ask that you require. I need to understand, where are you going to use the fund ask? Are you using it in marketing? Are you using it in sales? Do you require the money for growing the team? You need the money for manufacturing the product. Very important for us to understand. Now, we also need to understand what is the value of the money or value of your company. That is called the pre-money valuation. How much are you valuing your business for a fund ask of about 1 crore or 2 crores? How much are you valuing? Are you valuing because how you calculate is, it depends upon how much of revenue that you are generating month per month. Initially, say that you have generated about 2 to 3 lakhs per month for about 4-5 months. So that means you almost have about 8 lakhs of revenue that is being generated, and you're seeking 1 crore. To increase that 8 lakhs, that is 2 lakhs of growth down to a 5 to 6 lakhs. So when I am increasing it, so usually what we take is about maximum about 8 to 10 times the amount of revenue that is being generated in a year. That is your pre-money valuation. And you got to justify why you're valuing your company to such an extent. Like I told you, in addition to also you looking at the revenue that's being generated and the growth, the justification of valuation is a must to all the investors, for them to understand whether yes, for this company to grow to the next stage, this valuation at this stage of fundraising is the best. Finally, we are talking about exitability. As an investor, I love your idea. I put in my money as what you requested for. Now, what does the investor see? The investor needs to understand at what point he or she would exit that business. At that stage, when I am exiting that business, what is the kind of, if I put X amount, what is my returns? Is it a 2x return? Is it a 3x return? Is it a 5x return? Is it a 10x return that I can expect from this business? Typically, in an angel round, 8 to 10x, 8 to 10x returns is what they do. Now, in the same thing, when you talk about acceptability, we also need to understand if there are also other competitors who are there in your business. So have similar transactions been done for them? And what are the kind of exits that they have got if they've already gone to the next stage? This will give us a broad line of for us to understand that for this business, this is the kind of exit that we would be able to expect. And very important, like I told, what is the likely returns for the investors? Like I told you, if the investors put an X amount, or what are the kind of returns? Is he looking into, will we be able to expect a 5x or a 10x or a 15x return? This is very important for the investor to understand. Finally, we come to accreditations. Is on the way. How much, what are the kind of awards that the people have won? What are the kind of grants that have been given? Now, in case there is any certification that you have received, for you to go ahead and give us a certification, say that if you got any customer testimonials, for you to give us that customer testimonials, because this will only add to value to your product or software. So this is the end of it, guys. Thank you. So we will go down to Q&A.
Yeah, so thank you so much, Darshan sir. In fact, we had a rising number of participants, and there's been almost nil attrition of the participants. So it seems it's an interesting topic, and we have quite a few questions also which have come. Can I start with the questions, Darshan?
Please go ahead.
Okay. So the first question is why angel investors do not look at pre-revenue companies while other funds do?
The angel investors, we need to evangelize what is going to be the growth story. Now, evangelization of a company is basically based only on the basic revenue traction for 2 to 3 months. Only then will we be able to understand exactly what can be the growth. That's the main reason as to why investors always request entrepreneurs to start monetizing their product, run it for 2 to 3 months. Only then can we evangelize what is going to be the growth factor. Because as investors, we have seen a lot of deals which would be in that sector. So we need to differentiate. The next question is from Brijesh Kumar.
Yes. Do you want me to moderate?
No, I would read them. I would read them.
Okay.
Okay. Next one is Brijesh Kumar. Can we use angel funding for long-term projects? Brijesh, what exactly do you mean by long-term projects?
Okay, let me just check if I can unmute Mr. Brijesh. Yeah, Mr. Brijesh, I'm unmuting you. Yeah, Mr. Brijesh, you can unmute yourself now. I don't know if he's there. Mr. Brijesh, can you hear us?
Because I need to understand from him, what does he mean by long-term projects? Because long-term projects, are you trying to say some kind of a solar project, or are you talking about a long-term project in terms of wind energy? See, what happens in long-term projects, you need funding which which is capex intense. So you need money to be pumped in at a regular basis for you to sustain that growth. Now that would unfortunately not favor angel funding, because long-term, yes, we would look into a startup in long-term. When I talk about long-term, we are looking into returns within 4 or 5 years. So I do not know exactly what you meant by long-term project. How long are you talking about?
Okay, sir, I don't think he is available to talk. We can go ahead with the next question.
Yes. Now, next one is Heminder Singh. I got late in this session. My question is, what is important of a storytelling in a presentation for pitching? Heminder, it's an overall story, Heminder. Main important is what is the problem that you've identified, what is the solution that you're giving, what is the kind of a solution that you're giving. Is the solution very marketable? Is the solution a solution that someone is actually looking for, waiting, clients are waiting for this solution which has been missing for a long time? And that is very important for people to understand in the and not to miss out on the broader picture is how is it going to generate revenue, how is the growth story going to come in. Everything, each and every slide that I've shown you is interconnected to the others, but it's very important as to for you to tell you exactly what is the differentiation, what is the problem, what is the solution, what is the differentiation, and how much of production is being generated. Very important. Again, Himender has come out. What we should say if we don't have competitors for a product? What if a product is a novel one? As we have shown, have a show that clearly, as we have shown that clearly in a presentation. See, your product has, what's going to be, if you're saying your product is totally unique, and no one has that, now that is your USP. So how do you say that your product is unique? You got to I mean, showcase that to the investor. And how do you showcase that to the investor? In terms of you showing some basic revenue. If mine is a novel product, I don't have competition, then people are, it all depends upon how well am I going to market the product to get the eye of a customer to buy the product. Now, that is what we are clearly looking in. So if mine is a novel product, I do not have, you may not have direct competitors, but you'll have indirect competitors. In some way or other, there would be an indirect competitor. So how different, what is my differentiation from that competition? It's very important for us to understand that. Then Shabir Hussain, what is CapEx? Shabir, CapEx is the total amount that has been invested into the business. That is your, and CapEx is how much amount you have invested for setting up an office, setting up a manufacturing setup, getting your raw materials. That is your CapEx. How much have I invested into the business as an entrepreneur? That is what I need to understand as CapEx. The next one, again, Himinder Singh. As you have told that financial projects are for minimum 3 years, but if someone has a startup on COVID disease, for example, a diagnostic kit, how can one even project it for the next 2 years? Because no one knows what will happen after 1 year. Will there be a need for that product in the next year or not? So how, as a startup, can we give financial projections for the next 3 years? I mean that you have actually not asked me the question, you have actually answered the question also. So when, very true, when you have a startup which is coming, now you cannot, we are not asking you your financials as of now. I mean, or your financials, that is, I started, say that I started for 3 years financial. I'm saying going forward, there would have been some kind of traction that you have done, say for about 2-3 months because you are new. Okay, for example, diagnostic kit, you would have sold some diagnostic kit, and you know, it's very difficult for us to tell exactly how long this COVID is going to last. Take the example that it's going to last for 1 year. So then what happens? This may not be an investable business for investor, right? Because after 1 year, what is going to happen to your kit? No one is going to buy. So what are you going to sell? So finally, so that is why we ask for financial projections to see how are you going to be sustainable? How are you going to grow? That is why we require a three-year projection. If you're saying COVID, let me just tell you, Himain, that any business that starts, if it's not done in the proper, rightful manner, it's not going to last so long. So I can give a I can give a projection for 3 years, but it all depends upon my execution of the plan with mentors. How am I going to take it forward? That's very important. Shabir, can we get Presenter's contact. Yes, I can give you my contact, Shabi. Akshay has my contact. He will also, Akshay, please share my email ID with Shabir. All right.
Sir, I will put it in the chat room, please.
Okay. Next, sir. How do I conduct market survey? Is there any firms to help me? This is Raja Ganesh. Raja, I'd like to say, when it depends upon the kind of product that you're looking at. You know, you don't have to go to any firm to help you. Please understand, anywhere when you start up, when you have a startup and you are, I mean, you have a fund crunch. Please don't take a help of a firm. You can, everything is available on Google. You can go ahead and Google it to find out about the market survey. Everything is available, because the more that you spend at an early stage to get what is my market survey, you spend to others, it is actually eating into your amount that you require. So that means you require more funding. Unless, yes, there are firms that helps. I can also share the name of the firms that give you market survey, but it is always advisable for you to do the market survey by yourself. Vijay, good evening, sir. This is Vijay from Cardell Industries. We are developing next generation bioreactors. We have taken a part of our product and have developed a new product that could be used as a sterilizer from individual homes to offices. We have also built a POC for it. Will an investor be interested to join? Vijay, it's going to be difficult to tell right now, Vijay, because see, you have been developing generators for bioreactors. Now suddenly you've got an idea, and you have taken a byproduct of it, and you have used it as a sterilizer for individual homes and offices. Now you need to understand how many people are actually using such products. Who are your competitors now, and will the offices and homes actually accept it? At what pricing are you giving it? Is it feasible for the mass to buy it? Or is it only for a sect of people that you are targeting because your price points are high? So all this is very important, because only then, once the investors look into that, and like I told you, we need to see a basic traction, very important in such stages. I've got the product out, I'm selling it. I need to wait for 4 to 5 months to see how you're scaling. Only then will the investor join it. Now, Raja Ganesh, he's asking, what is ESOPs? ESOPs is basically my shares which I give down to my workers. So I have a share value for my workers. I'm giving it to them. Say that I'm giving it to them at 10 rupees a share, which goes out from their own salaries. So if I'm giving 100 rupees, if my salary is 1,000 rupees, I give them, say 10 rupees, I give them 10 ESOP shares. And the rest is 900 rupees is what I've given them initially. So this ESOP, which is at 10 rupees, as I keep growing, provided the employee is still with me. Now this, as I keep growing my company, I keep getting more funding. My equity share value goes up. So my ESOP value also goes up. So if I have the same employee with me for about 4 or 5 years, from 10 rupees, the ESOP would have gone up to 1,000 rupees. So just imagine the kind of money that your employee has, and this is a kind of a retainer. Praveen, does angel investor need prototype of device to fund for early stage startup? Praveen, we are going one step forward, Praveen. In addition to a prototype, we also need to see basic traction. Prototype alone will not yield in an angel investor to invest in, because the person has to see what is the viability in the market, how many people are buying it. So we need to see that basic traction. Guys, I'm sorry, we are running off short of time. So the other questions are there. So Akshay, I request you to kindly share the questions with me. I will answer them, and you can give it back to them. Unfortunately, we're running short of time.
Sure, Darshan. Can I ask the participants to write to you? I have anyway shared your email.
You can, I request you to collate all the questions, Akshay, and send it to me. It becomes easier for me to go ahead and answer them.
Sure. Participants, what I'm doing is I'm sharing my email ID on the chat, and you can write to me, and I'll ensure that the things are answered by Mr. Darshan. Yeah. So yes, Darshan. So that's about it. So thank you so much, everybody, for joining. I hope you all filled in the feedback forms as well, which will help us conduct many more better sessions like these. So thank you so much, Darshan sir. That was a very informative session, and I must say, everybody would have got clarity about different stages of funding and what they should do. So hopefully, one of our attendees raises funds soon, and to Chennai into hopefully.
Absolutely. We would be very happy to actually, in case there is one of the attendees here and coming forward to Chennai Angels, I would be very happy to actually assist them.
Yes, definitely. So, quick piece of information. In fact, CIIC and Chennai are partners. So, in case you would want to do a bit of work before reaching out to Chennai Angels, CIIC will be very happy to help you out with that. So, we are an incubation center based out of Crescent University for people who are coming for the first time. And we've helped multiple startups raise funds, and also multiple startups go to the market. So, we'll be very happy to help you out. So once again, thank you participants, and thank you Darshan sir for your time.
Thank you. Thank you, Akshay, for giving me the opportunity, and thank you attendees to giving a patient feedback. Thank you.
Our pleasure. Thank you everybody. So participants, I'll end the webinar now. Thank you.